Good evening. Thank you all for joining us today. We are excited to have you all here for our investment strategies webinar hosted by the UCR Office of Alumni Engagement and the School of Business. My name is Brian Emethan, and I'm the current president of Hylander Financial Group here on campus at UCR. HFG is UCR's premier investment finance organization with the goal of providing students with hands-on equity analysis and portfolio management experience through our two student-managed investment funds and competitions. We've provided a great amount of opportunities for students looking to excel upon entering the field after graduation, and we look to serve as a pillar of the UCR finance community. Today, I am joined by Greg Ritchie, Associate Professor of Teaching in Finance at the UCR School of Business, Manasa Savanur, a UCR alumna and Senior Assistant Vice President at Wells Fargo, and Ayushi Shah, another UCR alum and a financial advisor. Today, we will be discussing a few topics related to the basics of investing and how to be a good investor. Our four main topics will be the prerequisites of investing with Greg Ritchie, types of assets and retirement accounts with Ayushi, how to invest smart with Manasa, and investing according to your individual goals with the panel. We have allotted time at the end of the session for questions from the audience, but if you do have any questions for our guest speakers, please do not put them in the chat, but rather put them in the Q&A box. As a note, this webinar is being recorded and will be available on the UCR YouTube channel. We will send a follow-up email with the link. Additionally, closed captioning is available for the webinar if you click Show Captions in the menu bar. Now, it is my pleasure to introduce Greg Ritchie, who will discuss the prerequisites of investing.
All right, good evening, everybody. I know everybody wants to learn all about investing, but I just want to talk about a few of the things that you need to do before you start investing, because whenever you put money into an investment through your retirement account, you want to make sure that it can stay there optimally until you retire. In fact, I just heard a really cool quote from Warren Buffett's right hand. You all know who Warren Buffett is. Warren Buffett's right-hand man, Charlie Munger, and he passed away about a year ago at 99 years old, but he said, the first rule of compound interest is to never interrupt it prematurely. So that's why I'm going to talk about these prerequisites of investing, just to make sure that any money that you do put into the retirement account can stay there until you retire. So the first thing you need to do, and it's intentionally the first thing you need to do, is to create a budget. And I know that we're not all accountants. I'm not an accountant, but you need to be the accountant for your household. So you need to have an idea of what you own, what you owe, what's coming in. That's easy. What's going out? I have no idea, right? So that's why you start to create a budget. And a budget can be pretty simple. It could be done like on a Google sheet. It could be done just on an Excel spreadsheet. There are also budgeting apps out there, such as, I know it used to be Mint Mobile, but I don't see Mint Mobile anymore. There's a new one I've seen recently called YNAB, and I was like, what does that say? It stands for You Need a Budget. And a lot of these budgeting platforms here, they have like a free service, but then they'll have you pay more for a subscription. So be really careful there. So when you're creating that budget right there, part of that budget is going to be dedicated to investing. And again, how much should you invest? I don't know right now, because everybody's a little bit different. But the very first book that I ever read about finance and investing was like about 40 years ago. And the title of that book was The Richest Man in Babylon. And a common theme throughout that entire book was pay yourself first, and that's going to be according to the budget, and 10% of what you earn is yours to keep, right? You have to pay all of your bills, but you also should pay yourself. So starting off with a 10% goal might not be that bad, right? So we have our budget balance right there. So now let's use the budget to get rid of some other prerequisites before we start investing. So the next thing we want to do is we want to create an emergency fund, right? So what is an emergency? Well, if an emergency happens here, we want to make sure that we have enough money right here, about 3 to 6 months of expenses, just to make sure that we can weather the storm, right? Maybe our car breaks down. Maybe let's say, for example, it was really hot this summer. Maybe our air conditioner breaks down. Maybe we're unemployed for a few months. And if you don't have an emergency fund, well, what's going to happen is that you might start to withdraw retirement funds prematurely, or you also might start to rack up credit card debt. So get that emergency fund started. Now, where do you keep that emergency fund? Now, I know everybody here probably has their checking account or savings account at Wells Fargo, Bank of America, Citi, Chase, right? But I would shop around for some type of a high yield savings account, that pays the highest interest rate possible. And most likely it's not going to be where you have your checking account, because checking accounts are pretty much just for liquidity, convenience, and service right there. So I have that 3 to 6 months emergency fund in a high yield savings account. I can weather the storm. But speaking about credit card debt, that's the next prerequisite. So before you start investing, you want to make sure you pay off that credit card debt. I know that somebody out there has had an uncle or an aunt who's told them, hey, it helps your credit score to carry a balance from month to month. No. Visa and MasterCard want you to believe that, but you want to get that stuff paid off as quickly as possible. In fact, I checked out the Federal Reserve about a couple days ago, and right now, the total amount of revolving credit, that means you can use it more than once, like a Visa card or a MasterCard, as long as you don't go into default or over your limit, is about like $1.3 trillion. And about 1/3 of all credit card users are what we call convenience users, like me. We pay off our bill 100% in full right there, and then don't carry a balance. But about 2/3 of all credit card users are what we refer to as borrowers, meaning that they carry a balance from month to month. And that typical interest rate on a credit card right there is about 23%. So over like the last 40, 50 years or so, the stock market has given us an average annual return of a little over 11%. But if I'm earning 11%, but then also paying about a 23% APR on my credit card, that's not a good idea right there. So I balance that budget, start that emergency fund, and get that credit card debt paid off. Now, a couple of other things right here might not be applicable to everybody, but make sure you have adequate life insurance. Now, here we go. If you are unmarried and have no children, then you probably do not need life insurance, because most likely nobody depends on your income. But that doesn't mean that somebody who's working off of commission won't still try to sell it to you. We have a saying in life insurance that life insurance is more often sold than it is bought. So when you're ready to get it, then shop around for that just in case there. Okay. Now, a couple of other things going back to that, credit cards. Make sure you monitor your credit report. Check your credit scores often, right? Because what we say here in the credit industry is that you earn your terms and conditions, and having an excellent credit score can save you tens of thousands of dollars in interest over the life of like a 30-year fixed rate loan. And I'm sure most of you either own a home, or you might want to actually purchase a home sometime in the future. All right. Now, and here's another thing that before we get started with investing is that you can't buy the investments that they're going to talk about on eBay or through Craigslist. So you need to open up a brokerage account. Now, I've been a client. I'm not, putting out a shout out or anything like that, but I've been a client with Charles Schwab for about 30 years. They're a discount broker. Everything is very convenient through them. Through UC Riverside here, my retirement is through Fidelity. So we have Charles Schwab, Fidelity, there's E-Trade. So a lot of good brokerages out there to choose from, right? So once you've taken care of all of these prerequisites, you open up that brokerage account, you're ready to start investing.
Thank you, Greg. Next, I would like to have Ayushi up to discuss the types of assets and retirement accounts.
Hi, everyone. Thank you for the quick introduction, Brian. I'm so happy to see all of you here and be back at UCR events. I thoroughly enjoyed my time being a part of HFG and HSIF during my time at school, and served as an ambassador at the School of Business. So I'm really happy to be here and share my knowledge with you. Okay, so let's talk about the type of retirement vehicles and options that are available to an individual. So what is IRA? IRA is an individual retirement account that is a long-term retirement savings plan designed to help individuals to invest their money for their retirement years. So basically, it's a tax-advantaged account useful for any individual to save money in a very tax-efficient way, which you can use during the time when you cannot go to work and you're retired. Maybe you spend it on a family holiday or a house or whatever you like. So it's very important to know that IRA is not a tax, is not an asset, it's not an investment asset. Rather, it's a vehicle through which your funds are invested into other assets, such as stocks, mutual funds, equity bond, or just, EDFs, which is managed by companies such as Fidelity, Charles Schwab, etc., as already mentioned. So let's talk about the traditional IRA first. Traditional IRA is a pre-tax contribution, and the contributions are completely tax deductible. So basically, you make your contributions before you pay any tax on your income. So it lowers your income, and you pay less tax on the entire income out of it. Uh, there is a 10% penalty if you do an early withdrawal before the age of 60. So in case you're planning to invest some kind of money into traditional IRA, and basically you do that to just defer your taxes towards the end, but you end up doing an early withdrawal, you not only pay tax on it, but then you also pay a 10% penalty, which is something anyone should take care of. Any contribution that you withdraw at the end of your retirement period is taxed at ordinary income. So basically, you defer your tax, you defer it from today to tomorrow when you do not have income. Traditional IRA is usually suitable for people in the lower income tax bracket. As I said, you pay contributions before your taxes, before you pay taxes on your income. So your income reduces by the contributions. The Roth IRA, on the other side, is completely opposite. The contributions in a Roth IRA are non-deductible, and they are completely tax-free at withdrawals. So basically, you pay contributions after you pay taxes first. And once you are at the retirement, you can withdraw money from your Roth IRA, and it's completely tax-free since you paid tax earlier on the income when you were trying to contribute. But you have to take care of certain conditions where you will not be taxed, and those conditions include that your account should be open for at least 5 years, and you should be of the age of 59 and above at the time of withdrawing. Same with traditional IRA, there is a withdrawal penalty of 10% on the income earned. So in case you try to do an early withdrawal, take care of the 10% penalty. It is usually suitable for people within the higher income bracket. So someone within the lower income bracket would try to invest in the traditional IRA, but someone who falls in the higher income bracket would go for Roth IRA. It is also important to note that there are limits for every year. So a person can invest up to 7,000 in both the accounts together. So one can invest either 7,000 in traditional and 0 in Roth, or 0 in traditional and 7,000 in Roth, or any combination where there's a total of 7,000 per year. The limit for people above 50 years of age is 8,000 and not 7,000 in that case. So I would like to share how a 401k works. So a 401k plan is basically very similar to a traditional IRA. However, it is offered by the employers, where employers as well as employees, they contribute certain amount into the account. So for example, the employees invest a part of their paycheck into the 401k, and the employers would do a 50% matching on that. So it's like the employer does 50 and the employee does 50 to make 100% in your account. There are certain limits in it where you can do contribution only up to 6% of your salary, and the number of years you have worked in the company. So I think it's very important to talk to a financial advisor before investing. Same with the traditional IRA, there is a penalty of 10% if you do an early withdrawal. So always take care of those penalties. All right. So now let's take a look at the various asset classes that one could invest in. These include typically stocks, equities, which are usually used to create wealth and beat inflation. So the key is to invest in the right stocks and staying invested for longer periods that suit your horizon and risk tolerance. Other investment classes are fixed income, usually known as bonds. Bonds are where you invest to preserve your money, and it's as good as lending money to a company where you get interest on the money you've lent. Other type of investment options are real estate investment properties, such as commercial residential properties. One could also invest into commodities such as precious metals, gold, grains, steel, etc. One could invest into mutual funds or ETFs, also known as exchange traded funds. Uh, all other options such as cash, your bank accounts, your high yield savings accounts, your money market funds, etc. People also invest a lot into cryptocurrency these days, but I would suggest being very cautious prior to investing, and not not investing before understanding what it is, since it's not a very well regulated market as of now. I also feel that before investing, one should note down their goals, which include your current as well as future goals, and take a note of your risk taking capacity. One could be very risk averse and one could be very risk seeking. So, a person who's very risk seeking can take a lot of risk in the market according to his capacity. Also, last but not the least, do not put all your eggs in the same basket. Never do that. Always invest different kind of amounts into different asset classes to make higher returns in the long run and benefit from diversification. I feel it's creating a safety net. In case one of your asset classes are not performing well, you fall back on the other asset class which is performing well, and your overall portfolio doesn't suffer that much. So I feel let's do a deeper dive into all the asset classes one by one, and my friend Manasa can help us do that.
Thank you, Ayushi. And now we will have Manasa for how to invest smart.
Right. Before we jump into the details, let's begin by discussing why investing is important and how is it different from savings. For example, if you have saved, let's say, $1,000, you could keep it in a bank in a current account or under your pillow. But there's a downside to it, and that is inflation. Today, that $1,000 might buy you a good laptop, but in a few years, due to inflation, that same laptop could cost, $1,200. And this is why investing is crucial. By investing, your money has the potential to grow and outpace inflation. And that is kind of the goal. It helps you in maintaining or even increasing your purchasing power. You could invest in stocks, equities, government bonds, corporate bonds, real estate, NFTs, crypto. You can be an angel investor and invest in startups even. But again, being an angel investor has an entry barrier. It has a minimum amount for investing and things like that. Crypto is, again, extremely risky. So stocks, bonds, and ETFs are more accessible and easy to invest in for regular folks like you and me. So let's do a deep dive on it. Stocks, equities, shares all mean the same thing. Okay, if it's confusing, it's the same thing. It represents ownership in a company. When you buy stocks, you own a part of the company and you can benefit from the company's growth through dividends and share price appreciation. Stocks are generally riskier, but it also offers a higher potential for return. Bonds, on the other hand, is like a loan you give to the government or companies, and in return, you earn interest over a set period. And your principal is repaid at maturity. Bonds are typically less risky than stocks, but again, they have lower returns. Now you may ask, what is a good mix of stocks and bonds? Is there a general guideline for this? It completely depends on your risk appetite, on how much risk you are willing to take with your hard-earned money. A common approach is the 100 minus your age rule. Now, this is not academically vetted or anything, but it's a good guideline, okay? So subtract your age from 100. If you're 30 years old right now, 100 minus 30, 70. So 70% of your portfolio can be in stocks. The rest, put it in something more safer like bonds or a savings account. And if you're closer to retirement, if you're 60, you want to take less risk. So you would keep 100 minus 60, like 40% of your portfolio, you would want to put it in stocks, and the rest, 60% or more, in bonds and ETFs and safer investments. Now, if this is all too complicated for you and you don't want to do all of this, ETFs are an easy way to invest. ETF stands for Exchange Traded Fund. So it's a fund, everybody pools in money, and instead of you individually picking stocks and having and running your own portfolio, you'll have a fund manager, a portfolio manager who does that for you, and you'll pay a small fund fee for it. But if you're interested in doing this on your own, which you should definitely try out, the next question would be, how can I find good stocks and bonds to invest in? Right? Well, the answer is research. Follow the market, observe trends, read about the companies you would like to invest in. In fact, just pick their annual report and go through it. Even if you don't understand much, it's pretty informative and it gives you a good sense of what the company is doing and if you think it makes sense in the long term. So do your homework before investing and just get started. Don't worry about how much to invest, how often to invest. You can figure all of that out. But do start, and it really depends if you want to be a more hands-on and active investor, or if you want to invest in lump sum, like invest once in 6 months or once a quarter. And again, it all completely depends upon how much control you have over your living expenses. If you're someone early in your career, you want to move to a different state, a different city, a different job, you don't have all your expenses in control, or if you foresee a huge expenditure, you don't want to do an automatic investment strategy because again, it makes things difficult for you. And investing is something that should make your life easy, not difficult. So take it slow, do it at your pace, and the key here is to do your own research. Right, over to Brian.
Thank you, Manasa. And now with our fourth topic, we'll look at investing according to your individual goals. I have a few questions for our panelists that were sent in prior to the webinar, and so we'll just jump into the first. How active should I be with buying or selling investments?
All right, I can take this one. So continuing what I just said, actually, it really depends. Your activity level depends on, first of all, how much time you have, to be honest, because if you are someone who's working already like a regular 9 to 5, you also need to understand, especially if you live in Pacific time, the market actually runs on EST. So first of all, if you're someone who wakes up late, you're already missing out on all the action that happens. So make sure you are willing and you're able to do what you set out to. So just coming down to the practicality of it, day trading, active trading is not something most people can do. And also there's no need for it. So invest and hold. I am someone who personally invests for the long haul. And also if you invest short term, it attracts short-term capital gains. So it's something you want to avoid. But again, if you are a complete beginner and you invested in something and you're losing money, I'm not going to say just sit and wait. So it again depends on what you invested in. You can also seek for professional help. You can also speak to other people who invest actively but don't follow market trends. You got to do your research and take it slow. If you're a beginner, don't have strict rules, but long term is my answer for this.
Thank you, Manasa. Anybody else want to tag in for that? Okay, and I will jump into our next question, which is, what are some risks involved with investing lump sums of money versus investing, say, monthly?
I'll go ahead and take a little stab at that. Right. So basically, when I was talking about the budgeting right here, I believe that just in this situation, that investing should just be automatic. First of all, when you do this automatically, it basically becomes a habit. I know that when I was younger, I felt motivated to invest, but now it's just basically a habit in the sense that every month when I get paid, some of my money goes into my retirement account here at UCR. Some of my money goes into my Roth IRA through Charles Schwab. And I know I don't get emotional about it in terms of thinking about, well, maybe instead of investing a certain amount of money every month for the next 6 months, maybe I'll just hold off and then try to invest all of the 6 months worth of deposits in 6 months from today. Then you get into the problem of trying to time the market. And the market can stay irrational longer than all of us can stay solvent. And that's a very popular expression there on Wall Street. Another problem that I think that might happen with that is, let's say, for example, in January, February, March, April, May, and June, I don't put anything into my retirement accounts, but maybe I might have some type of a lump sum of money waiting to be invested. Well, there's a possibility that I might not even end up investing that to begin with, right? Some of my friends might say, hey, we're taking a summer trip here to Hawaii, and well, I haven't budgeted that, but I do have all of this money that should have gone into my retirement account the last 6 months. So again, just make it automatic, something that's like a must do. That's how I look at it.
All right, thank you. I know this was slightly touched on previously, but how would investment strategies differ across different age groups?
Yeah, I'll take that one. So remember the 100 minus your age rule. It's a good place to start. Again, it's not something you have to do. It's just a guideline. Now with age, what happens is you can, depending on your risk appetite, if you want to invest aggressively, what investing aggressively means is investing into more riskier things. For example, you want to invest in crypto or stocks which are more volatile, like Tesla, Nvidia right now is pretty volatile. So that becomes risky. And when you're young, you can kind of take that risk. So age is, of course, like they say, it's just a number, but if you want to be, safer and you don't want to take risk, then it depends. With age, with closer to retirement, when you want to rely on your savings and your investments, that's when you shouldn't be taking risk. So with age, just reduce your riskiness of your portfolio.
I'll go ahead and add a couple of things to it too. That's great. The thing is, sometimes we're thinking about, okay, well, when I'm really young and I have a long time into retirement, I don't want to be too conservative, because I want to make sure that this money is, invested, at a high enough growth rate to, way outpace inflation. And then, of course, then when I get very, very close to retirement, I don't want to be too aggressive, because let's say, for example, if I'm 55 years old and I want to retire in 5 years, if the market tanks, meaning like a 10% drop, we call it a correction, or a 20% drop, we call it a bear market, chances are it's not going to recover by the time I retire. Then I might have to prolong my retirement there. All right. So on the other hand, if I'm being aggressive and I have like a big allocation of the stock market, let's say using that rule there, I'm 20 years old. So basically, 80, even maybe even 90% of my money there for retirement should be in the stock market. If the stock market drops, then a 10% drop, 20% drop, which are common, right? So don't get scared and don't cash out. But it will recover. The stock market over the long run typically goes up, up, down, 2 steps forward, 1 step back. Where will the market be in about 2-3 years from today? I'll keep my fingers crossed that it's higher, but I have no idea. Where will the market be when most of my panelists right here are ready to retire? Most likely it's going to be a lot higher than what it is today. Luckily for us, we have different investments out there that will help us manage that strategy of not being, too conservative when we're young and too aggressive when we're closer to retirement. So we have what we refer to as these target date mutual funds. Sometimes we also call them life cycle mutual funds. When you pick a target retirement date, Fidelity packages them. They call them the Fidelity Freedom Funds, meaning that you're free just to kind of forget about them. Just fund them and fund them and fund them every month, every year, every decade until you retire. If any of you guys, I know you're all UC Riverside alumni, if any of you work for the University of California, we call them pathways, UC pathways retirement accounts. So let's say, for example, I choose one. This wouldn't be for me right here, but let's say I choose Fidelity Freedom, and Fidelity is a brokerage, but they also package mutual funds. I choose a Fidelity Freedom 2060 fund. That assumes that you are going to retire in the year 2060, right? So, a little less than 40 years from now. Right now, that fund would be heavily allocated into a diversified portfolio of stocks. Probably about 95% of the portfolio would be stocks. Only about 5% of the portfolio would be lower risk, lower return bonds. But gradually, as the years go by and you're getting closer and closer and closer to retirement, every few years, the portfolio reallocates out of higher risk, higher return stocks into lower risk, lower return bonds. So by the time that you reach retirement, you're back to what that rule that Manasa talked about a little bit ago, right there. You're conservative, you're appropriate for your age and your proximity to retirement there, right there. So there's no magic way to do it, but some of these funds here that I mentioned right there, their expense ratios are actually not that bad, like an expense ratio of like 0.2%, 1/5 of 1% per year. And they're diversified. And that's one of the most important things out there.
Thank you for that. It's always worth keeping in mind, your goals, one of the main ones being retirement, and of course, your risk aversion. But thank you. One more question is, how can I reduce taxes on my investment profits?
I think I can answer that. So basically, taxes on your investment profits depends on three things. One is type of your investment. Second is how long have you held that investment. And third is your level of income. So typically, there are three types of taxes on any kind of investment profit that you make. First one would be capital gains tax. So capital gains tax is basically the profits you make from selling the investment, and it can be either short term or long term. So short term tax is something where you sell off the investment prior to a year. So within a year, if you sell something off, you pay tax from the range of like 10% to 37%, depending on your tax bracket. But if you sell your investment after a year, it calls out as long term capital gains tax. And the tax on long term gains is ranging from 0 to 20. So if you see 20% is much lesser than 35%, 37% tax. So I would always suggest holding your investments for more than a year and looking at a longer horizon to save tax on your long-term gains. Also, there is dividend tax. So basically, companies where your shareholders are made payments every year from the profits they make, and they are taxed at ordinary income. So basically, you get dividends from these companies from their extra profits on top of your capital gains, and you end up paying tax on that. There's another kind of the tax on interest income. So basically, interest income is the income you receive from investments. So for example, you've bought bonds and you get interest income on bonds, or you have a high yield savings account. All these interest incomes are also taxed at your ordinary income. There are various ways to lessen your tax burden and save money. I think one of which would be investing in these tax advantaged accounts, as I spoke earlier, the IRAs, 401ks, and defer your tax. for the future. So you save money right now and pay less in the future when your tax bracket is also low. You could also buy municipal bonds. Municipal bonds usually have uh, interest income that is exempt from taxation. So it could be a good option for somebody to make investments in municipal bonds, and the interest income could be completely tax-free. You could also invest in tax deferred annuities that also work on the same fundamentals of IRA and 401ks. I would also suggest for people who are making losses in their investments, do one thing called as tax loss harvesting. So basically, you cut off your losses and you just book your losses in front of the other profits. So these losses and these gains, they offset each other. So you end up paying very less tax on your overall capital gains. Yeah, these are some things that one should do.
All right, thank you so much. Once again, thank you everyone. But we're now going to open it up to questions from the audience. Please type your questions in the Q&A box and we'll try to get to as many of these as we can. Looking through, I did want to bring up one that was asked earlier. Leaving money in a retirement account makes sense, but what if the account was through an employer and you no longer work for them? And you'll probably not encounter the same retirement account organization through a different employer.
Okay, I'll start off, and then probably Manasar or Ayushi, who work currently as financial planners, advisors, gonna add something to it. So basically, when you leave a place of employment, there's from what I've always heard, there's like basically about 4 things that you can actually do with the retirement plan that you had at your previous employer. And the first thing you can do is you can roll it over to the new employer, right? You don't withdraw it and then deposit it. Once you get to the new employer, you tell the new employer that you had a retirement account at the old employer, and they will do the rollover for you. You can also roll it over into an IRA. You can roll it over to an individual retirement account. So remember, the 401k plan, that's through your employer. The IRA is an individual retirement account that you have through your broker and maybe with assistance with a financial planner, all right? So that's the 2 things you can do. Number 3, you can also just leave it at the old employer. They're not going to match any contributions. They're not going to add anything to it. You cannot continue to add anything to it, but that's an option right there. Number 4 is the worst option. The worst option is that you cash it out, okay? Basically, and a lot of times this happens when someone is even actually unaware that they had some type of a retirement plan at an old employer. So they left their job. 6 months later, they get some letter in the mail from their previous employer. You have a $10,000 in a retirement fund with us. And it'll even tell you can roll it over to the new employer. You can leave it here. You can roll it over to an IRA, or you can cash it out. Now, when you cash that out, right off the bat, you're going to get hit with a 10% penalty. You're going to have to pay federal taxes, state taxes. Most likely they'll send you a check for about 2/3 of what you actually had at that old employer right there. So convert it into, roll it over to an IRA, roll it over to your new firm's or new employer's retirement account. Unless it's some type of a strange retirement plan that you had at the old employer. But if just a general, either 403B plan, which is in the public sector, 457 plan, which is in the public sector most of the time, or a 401k plan, which is typically an employer-sponsored retirement plan in the private sector or corporate sector there, okay? But don't cash it out, whatever you do, right?
All right, thank you. Unless anybody else would like to touch on that, the next question is, are high-yield savings accounts taxed?
Yeah, high-yield savings accounts that you would open up like either at any type of a bank or a credit union, or even now, like I said a little bit earlier, with, that's probably where you would keep your emergency fund. Don't rule out any of those what we call online banks or fintechs, as long as they're what we refer to as, they have, in fact, I don't know, sometimes you guys still go into your actual bank branches, and Rod, there's that sticker that says FDIC, Federal Deposit Insurance Corporation, right there. That basically means that your deposits are federally insured. So most fintechs or online banks, they're also federally insured. So it's okay to actually, send your money. I know I get nervous sending money out there into cyberspace, so to speak, or even doing anything through an app right there. But those will pay interest, but that's just taxable interest there. However, you can actually keep your Roth IRA money in what we refer to as a high yield savings account. But since it's through a broker, we would refer to it as a money market account, which is basically like a high yield savings account offered through a commercial bank, but a high yield, what we refer to as a money market fund offered through a broker is not insured. So it's not FDIC insured because it's a brokerage product right there, but it is just taxable. Unless it's in your Roth IRA, then it's not taxable. But most likely for your Roth IRA, you're not going to be keeping like emergency type short-term goal money in a retirement plan, okay? In a retirement account there. Yeah, so it's taxable, right?
All right,
You
thank
always
you.
pay taxes once on everything, okay?
Of course, thank you. Next, we have, would it be wise to buy a whole life policy when you're young?
I think I can answer that question since I also work in that same domain. I myself have a whole life policy, and I really suggest everybody in their early 20s start off early, buy a whole life, because that's the time when you're the youngest, the healthiest, you get the best ratings. With the best ratings, you also have the least amount of premiums. And since you just are getting older each day and not healthier, so it's much better to have it right now. It's also a good savings fund where you save some amount every month, and you have enough time. If you invest early, you have enough time throughout your life for your account to grow with the cash value, and the cash value is also tax deferred. So you save up money on that, and with the tax advantages as well as the cash value growth, you can borrow against that cash value in the future. So the earlier you invest, the earlier you buy a whole life policy, you're going to have large sums of money in your cash value.
All right, thank you, Ayushi. And next, we have, what is the limit for 2025 IRA contributions?
For most people here, it's 7,000. For me, it's 8,000. Manasa and Ayushi would probably know why.
Yeah, part of the disparity is people over a certain age end up they're given more allowance for how much they can contribute in a year. So 7,000 and 8,000 per year.
In fact, there was one time where I was putting money into our IRAs, and I told my wife, I said, well, this was when it was 5,000 and 6,000. So a while ago, I said, well, I told her, well, this year we're going to put 6,000 in mine, but only 5,000 in yours. And I'm like, well, then because I was older right there, and of course that
All right, thank you for that. One more question. Are you able to give a numerical range for low income bracket versus high income bracket? If I can jump in, I know that ranges from whether you're filing as a single individual or a married individual, but that is also something that does change from year to year. I don't know off the top of my head, but it's always something that you can look up and find, the individual versus household income limits for the tax brackets.
right. So the various tax brackets, and just for like the common sense definition of the word too, it's like it depends on where you live, right? So I keep reading about these people earning $150,000 a year as first, second year investment bankers in New York City, and they're broke, right? Whereas that amount of money can buy you a mansion in other states there. So a lot of that there is subjective right there. And of course, here in California, I don't know where everybody is from the webinar, but in California, yeah, things are pretty expensive. So.
All right, thank you for that. Just as a reminder, if you do have a question, please enter it in the Q&A box. Instead of raising your hand, we are unable to help out with that. But to move on to the next question, do a lot of people have both 401k plans and IRA accounts?
I can take that one, and the answer is yes. Many people have both 401ks and IRAs. And in fact, it's a common strategy. And the reason is 401ks are provided by employers and often with a company match. So it allows for higher annual contribution limits. However, investment options may be limited, and there could also be a fee, and it completely depends on your 401k policy. And with the IRAs, it offers more flexibility in choosing investments, and it is not tied to an employer. It could be, but you can also have your individual IRA, and it also provides certain tax advantages, but also with lower contribution limits. So having both kind of helps you increase your investment. And it also helps you diversify, and that's actually the point of having both.
And a lot of times individuals out there who have like a 401k plan or a 403b plan in the public sector through their employer, those are what we refer to as being like, they're tax deferred, right there. So you'll get a tax deduction every year, tax grows deferred, but when you withdraw to retirement, you have to pay taxes. So when they choose their IRA, a lot of times they'll choose the Roth IRA, which is funded with your take-home pay, but then grows tax-free. So we actually did a little problem in my class last week here. We were taking a look at what we call time value of money and letting money grow and see how much you'll have. And we had basically somebody invest $5,000 every year for the next 40 years, let's say from age 25 to 65, right? Easy way to do it. And let's say they earn about 10%, an average annual rate of return of 10% per year, right? So, stock market over the last 40 to 50 years, 10, 11% per year. So it's not, knock on wood, keep your fingers crossed, not too optimistic to hope that we get that over the next 40 years, but they ended up having $2.2 million right there in that retirement account, right? This is all through like a diversified stock portfolio, obviously, but that entire $2.2 million that's in that Roth IRA will be tax-free upon withdrawal as long as they're over 59 and a half years old right there. So it's a good mix there. In fact, you guys could probably Google something like about, you're all UCR alumni, so you all took those math classes like PEMDAS, right? The order of operations, like PEMDAS, maybe starting off with whatever my employer is going to match to my 401k plan. That's what I do first, because otherwise you're, throwing away free money. Then after you maybe max that part out, then maybe go to the Roth IRA and then max that out right now, the $7,000 per year. And then maybe go back to the 401k plan. So there's like a order of operations for that there. And it kind of mixes up when you pay taxes. So it kind of helps out with that as well.
Yeah, the more money you have growing, the better, especially when it's tax advantaged, as in those retirement accounts. Thank you. Another question. I want something that has high liquidity for times that I need to get funds quickly. What do you suggest?
High liquidity, I suggest investing into high yield savings accounts or the money market funds. You can transfer or cash out the same day or the very next day since it's already with your bank. People have a misconception that stocks are very liquid. However, personal experience, when I try to sell stocks, I get in money like after a week or so, or if you want it the very next day or 2 days. With the settlement period of T+1, they charge some kind of fee to get it immediately. So stocks are not that quite liquid, but you should invest definitely into high yield savings accounts to get it the same day or the very next day.
Yes, definitely. Thank you for that. And on to our next question. Given that one of the biggest contributors to building wealth is time, do you recommend that one starts investing a small amount sooner than later to maximize the time, even if it means doing it before fully funding an emergency fund or substantially paying down credit cards?
I would always say first pay down your credit card no matter what. It's okay if you don't have an emergency fund. Everything is okay. It's okay if you don't go on that vacation, but no credit card debt. That's like the worst thing that can happen to your finances. So that's one. And the second one is emergency fund. I know, especially if you're younger, you don't find the need for it. You're like, what emergency? And I know my parents will pay it off if there is an emergency, and I get it. But eventually, with time, you want to have your emergency fund, and it depends on how much money you want to put into it. Depends on how well insured you are, and if you're married, if your spouse also has insurance, do they have an emergency fund? And it's, finance is always personal and complicated. But you do want to have a decent amount of money. Now, if you say your emergency fund is like $30,000, that's a different matter. But 10,000, 15,000 is something everybody, I think, should have in general. So no credit card debt and a decent amount in your emergency fund, and then only you should invest. And the reason I say this is because let's say you started investing without any of these, and then when things get difficult, or even if you plan to buy a house and you want to put down a down payment, if you're taking out from your investments, all of that gain and all that compounding, all of that is gone. So you kind of start from scratch in your investment portfolio. It won't look good, and then you just won't have that interest to do it. So to keep things separate is my personal experience, and that would be my advice. And you can do small amounts, it's completely okay. But if you have every month a certain amount, that is great. And if you're someone who does not make a very good income, and if your expenses are pretty high, the rent is pretty high, then it's okay to do a lump sum at the end of a quarter or something. But that can only work for a certain number of years till you get comfortable in life. It's not a long-term strategy.
Thank you, Manasa. And I want to say that does tie back into something mentioned earlier, which is building that budget and understanding where you can put your money. But thank you again. On to our next question. First, thank you to all the panelists for the fundamentals of investing, as I'm investing my time in this to learn. Thank you for your attendance. But can any of you share what the best indicator is to dump or sell off an investment before losing too much money?
I like this one, and this happened to me very recently with NVIDIA again. I invested when it was at its peak because I thought it would only go up and up and up, because that was how it sounded. So I invested at its peak, I think a couple of months ago, and then it just kept going down. And when this happens, it's very tempting to sell because you kind of lose confidence, and because the whole media and everything just shifted towards politics and a bunch of other things, and no one was talking about AI as much as they were, or about chips as much as they were. So it's very easy to think that, okay, maybe this is not going to go up in a couple of years. You might want to sell, but I would say when things go down, and if you think it's a good company, if you've done your research and you've invested it into something because you think it will do well, when prices go down, you buy some more. Now, again, this depends on how much money you have, how much you want to put in and everything. But if it goes down, you buy some more. The reason is, let's say you bought something at $150 and then the stock price went down and it came down to $100. Now, if you buy at 100, you bring your average cost down to 125. And so next time when the price just crosses 125, if it even goes to 130 or 140, you make a pretty decent amount of profit. And you're not like, oh my God, from 150 to 140, otherwise would be a down. But because you bought when it was $100, now 140 is like you've made profit. So it depends on how strong that company is also, and how much you trust in your research and investment.
Thank you. And to once again touch on what Greg had said earlier, the stock market may go down and up, but it'll always go up more over time. So always worth keeping that in mind. On to our next question. So what would be the cost to start? What are the costs associated with starting to invest? On a range, how much will we need to spend to start accounts?
Well, it's free to open a brokerage account right there. So then that's, and also as far as, you know, your 401k plan or 403b, you can start with as little as like, you know, $50 a month. They can, you know, get you in there really cheap. Also, in terms of buying shares of what we call an exchange traded fund, where you basically, and one of the ones I'll just go ahead and tell you what I've been doing like the last 35 years, is I pretty much just put most of my money into what's referred to as an S&P 500 index fund, or now an S&P 500 exchange traded fund. And all you basically need to do is to have enough money to buy one share of that fund. And then when you have more money, you can buy more shares. And when I buy one share of that fund, my money gets diversified into 500 large firms. So I don't even pay attention to how one stock is doing on a given day versus another stock is doing in a given day. But I do pay attention to how the market is doing. But it's very cheap to get into investments, right? Also now, most of the brokerages like Schwab, Fidelity, they allow you to buy what we call fractional shares. So you don't have to buy like a full share of stock. You can buy a fractional share of stock. In fact, Charles Schwab calls them slices. You can buy slices. You know, they got a little brand name for it right there. Okay, so that's when I think about like the market there, I think about the market as a whole right there in terms of like, well, I mentioned a little bit earlier about 11% average over like the last 50 years there, but it doesn't cost any money to get into it other than what you have to pay for the actual investment itself. Okay, there's no real startup fee per se, which is good. So you can start early and invest often, I think is important.
Thank you. As you said, really nice to be able to start early and let that money grow. On to the next question. Do you get taxed on gains in the investments you make?
Absolutely, you get taxed on everything, no matter what. Even if you invest, you know, you can buy a watch as an investment, and if you try to sell it, you get taxed. You can buy fine art or whatever, and when you sell that art piece, you get taxed because that is capital gains. And especially if you hold it for less than a year, like stocks and everything, you get short-term capital gains, which is higher than long-term capital gains. So, but you pay tax once, and you always pay it on a gain. Now, if you made a loss, you're not getting taxed. So, but that's not when you should sell.
Thank you, Munasa. On to our next question. How long should you keep a high yield saving account for? They've heard it's good for short term, but why instead of long term?
I think it's better to invest in the shorter term because of the accessibility that it has, and it's so easy to cash it out. For the longer term, I would suggest investing into the markets like stock markets, bonds, mutual funds to get better returns, because on the high yield savings account, you're anyways not earning that kind of returns in the longer period. So why not invest into stocks and get, you know, higher returns and beat the inflation? So yeah, you should do like a shorter period up to say 2 to 5 years on a high yield savings account for the accessibility, and longer period go for stocks.
There's kind of that adage that when you need the money determines where you actually deposit the money. So there's a difference between savings and investing. Typically, savings is like for your short-term goals, things you want to accomplish within the next year. And then there's investing right there, which is, well, there's kind of like a gray area because savings is also between like 1 and 5 years. So let's say, for example, if I'm saving up for a down payment on a home, I'm not going to keep that money in my checking account earning zero, but I'm not going to put that money in the stock market because, like I said earlier, I don't know where the market will be next year within the next 5 years. Could be up or could be down. So those high yield savings accounts or a money market fund through your broker right there are great places to, you know, earn some type of interest, but also maintain, you know, very little risk there. I mean, there's basically no possibility of loss. So if you're looking for like to save up for that vacation in a couple of years, I want to take a trip to Japan, that's where you would put the money right there, not in the stock market, because you might just be able to go to little Tokyo and Los Angeles instead of going to Japan if the market tanks.
I would like to add to this a little more of a banking perspective. And the reason you wouldn't want this for the long term is because interest rates keep changing. 5 years from now, maybe there's higher inflation and maybe the interest rate would go up. So if you have a high yield savings account, let's say if you took it a couple of years ago when the economy was amazing, you would have got it at some 3% or something, and today it's pretty high. So it depends on where you think the market is headed. US is still, a strong economy, but if, like, for example, I'm from India and we know how, inflation shoots up. So I have seen 7% returns and 5% returns. So you don't want to get, a small amount of return for a long period of time.
All right, thank you, everyone. Next question. If you are 40, would you recommend whole life policy?
It really depends on your budget. So basically, do you want to invest more into a whole life, or are you just looking for your death coverage? So if you're looking just for, coverage for when you die and you want to protect the people who are left behind and their income, it would be better to invest or, to buy a term life rather than a whole life. And since you're, nearing the retirement age, you can look into other options such as annuities. So yes, it really depends on your budget, but a whole life is much more costlier as you grow old. It's cheaper when you're young, so it just really depends on your budget.
Thank you. On to our next question. Would it be better to invest into a Roth IRA or a high yield savings account? Is it a big deal for which is more beneficial for students interested in continuing their education?
I think we have to remember here that a Roth IRA, remember, IRA stands for individual retirement account. So you open up that account and you put in investments. You buy stocks and mutual funds and ETFs with the intention of keeping them there until you actually retire after 59 and a half years old and start to withdraw them. A high yield savings account, again, more for like, short-term, intermediate-term goals, like saving up for a big purchase or a down payment on a home there, right? Because you wouldn't want to put that type of money into an IRA and then withdraw it in a couple of years because you'll get penalized there. So like when you need the money primarily determines where you put the money.
Thank you. On to our next question. Is there an income limit for being able to contribute to IRAs?
There is for the Roth IRA, but not the traditional IRA. And of course, the income limits, they increase gradually every year, but no income limit for traditional IRAs, just for Roth IRAs. And then, of course, it also depends on whether or not you're filing single, married, filing jointly, married filing separately, head of household. So they'll have different income designations for that as well.
Thank you. Similarly, what is the oldest you could be to contribute to an IRA?
There's no age limit to contribute to an IRA. With the traditional IRAs, though, there is an age limit now. I believe it's 73 years old, where there's what we call required minimum distributions, where you have to start withdrawing from the traditional IRA. Because remember, that's tax deferred. You haven't paid taxes on that. So the IRS starts to say, hey, we want our tax money there. Now, you can also contribute, though, to IRAs when you're retired there. But with a Roth IRA, you actually need to have a paycheck stub. So there must be some type of like, maybe I retire and I work at the movie theater. That's what I actually want to do when I retire. I want to work at the movie theater, sweet popcorn so I can get free movies there. But if I have that paycheck, I can continue to contribute to a Roth IRA there. Okay.
Thank you. And next, what's the difference between a whole life and an index universal life?
So the only difference would be in a whole life, you have a fixed premium set once you enter the contract or once you buy the policy, and you have a fixed cash growth value and a death benefit, which is also fixed in the start. With an indexed universal life, your cash value sort of fluctuates depending on the performance of the S&P 500. So it depends on the performance of the market. If the market is not performing that well, your cash value might not perform that well. And in the case of an indexed universal life, your premiums tend to go on higher as your age increases, and there's no set premium for that. So to be on a safer side, a whole life policy is less riskier, and a universal life policy could also make you tons of money with respect to cash value, but it just depends on the market.
Right. And next, when you are ready to approach a broker such as Charles Schwab, how much money minimum do you recommend to have in hand?
That varies. That's varies among individuals. But I'll be honest, though, most individuals who use a discount broker, when they open it up for the very first time, they probably don't have too much money. The first time I opened up an account at Charles Schwab, this was, I think we deposited about $2,000 there. So this was a long time ago, but they're not going to turn your money away, because what we have now is we actually have, like, you can automatically transfer money from, like, your Bank of America checking account to your Fidelity or Charles Schwab brokerage account. So as long as the money keeps flowing in, you can continue to buy shares of ETFs, mutual funds, etc. right there. So I don't know if there's a minimum limit, but then of course everybody's a little bit different in terms of how much they actually deposit to get started there.
Thank you. A next question here is, are municipal bonds usually acquired through a broker or another source?
They can be purchased through a broker right there. Most of the time, I mean, a municipal bond, though, just got to be really careful there. I know that they are tax-free, but typically if you take a corporate bond, a bond issued, debt issued by a corporation, and a municipal bond, a bond issued by the state of California, county of Riverside, city of Riverside, even if let's assume they have the same maturity and same risk, they're equal bonds in a sense, but one's issued by a firm, one's issued by a municipality. The bond issued by the corporation will be taxable, but the interest rates are higher. The bonds that are issued by municipalities, there's tax-free in quotes right there, but typically the interest rates there are much lower. And what happens basically here is that the municipal bonds are much more beneficial for people who are in higher tax brackets, because that tax-free, or that, just the idea of not having to pay tax, offsets the low interest there. Whereas with people who are in, middle and lower income tax brackets, it's just more beneficial for them to actually purchase a corporate bond and just pay receive the higher interest payments, and they're not going to have that big of a tax burden anyway, because their tax brackets are lower right there. So that's something you always want to talk to a financial planner about there, instead of, should I buy corporate bonds or should I buy municipal bonds? So, okay. And then again, if you're 25 years old and you're not going to retire until another 40 years from now, most likely you're not going to be purchasing bonds anyways, okay, unless you're very, very conservative, okay?
All right, thank you. Looks like a little clarifying question here. Is a Roth IRA basically a tax-free brokerage account? How much money can you attribute to the Roth IRA per year?
Yes, it is tax-free, but I put tax-free in quotations because you always pay taxes on something once. So let's say, for example, I open up a brokerage account, right, Charles Schwab, and I start buying exchange-traded funds, stocks, or mutual funds. Well, here's what's basically going to happen. By the time that I actually put the money into that brokerage account, it's already gone through taxes, right? You all work, you see, oh, gross salary, then you see federal taxes, state taxes, local taxes, taxes. What's taxes? I don't know, there's more tax. And then you get your take-home pay, you put it into your brokerage account there at Charles Schwab. But I'm not opening up a Roth IRA there. I just have the regular old brokerage account. And I buy some mutual funds, some exchange-traded funds. Then when I get my 1099 at the end of the year, that's the 1099 dividends right there, and you see your capital gains at the end of the year, I have to pay taxes on that again there, okay? And then when I withdraw them and sell them, I have to pay taxes again. The Roth IRA, in quotes, tax-free, basically means you only pay taxes once, when you receive the income through your employer. So I see my paycheck, I see gross pay, I see federal taxes, state taxes, etc. I open up my account at Charles Schwab, I put money into Charles Schwab, but I designate that money go into my Roth IRA account. Once it's in that Roth IRA account, I will never pay taxes on that again. It will grow tax-free until retirement, okay? So you always pay taxes once. And that's how it works with both a Roth IRA and a traditional IRA. With a traditional IRA, you pay taxes at the end. With a Roth IRA, you pay taxes at the beginning. If you're just investing in the market without either of those two, you pay taxes 3 times. So that's, I think, besides paying off your credit card debt and balancing your budget, that's probably the best advice that I could give anybody there, right? If you're going to invest, do it through an IRA or, of course, your employer there.
All right, thank you. Another question I see here, maybe a little bit more clarifying. What is the difference between investing in the S&P 500 versus into a Roth IRA?
Okay.
Go ahead, Manasa, yeah, and then I'll do some too, but go ahead, yeah.
Sure. So basically, the S&P 500 is just an investment, while a Roth IRA is actually a retirement account, and it can hold the S&P funds as well. You can invest through it, but you can also invest in bonds and other stocks and mutual funds. And the whole point is the Roth IRA is more about the tax advantage, and S&P 500 is just, it's just stock. What I have.
Right. The S&P 500 is an investment itself. It's basically a basket or an index of 500 large U.S. stocks to represent the overall market. So if somebody said, hey, how did the stock market do today? I'd say, well, the S&P 500 was up, 0.75%. The good thing about that is that you can monetize it. You can buy a mutual fund or an exchange traded fund that invests directly into the S&P 500. Your Roth IRA, like Manas says, is an account. It's a bucket. So you don't want to keep that bucket empty. You open up a Roth IRA, you put the investments into it. One of the first analogies I learned about that is, what's the difference between a Roth IRA and the S&P 500? It's like, I said, well, it's like shoes and socks right there. So your shoe is the account, but then the sock is in it too. Unless some of you guys just walk around with socks only or go sockless with shoes, but I think they go together, right? One's an investment, one's an account.
Thank you. Perfect. Another one is it better to invest a set amount of money on a monthly basis or to time the market for when the stock, ETF, mutual fund, etc. is low?
I never try to time the market. Never try to time the market. Just make it automatic. Make investing a habit.
Yeah, it's always.
If anybody has a crystal ball, though, and can predict the market, please tell me. I wish I had that. Oh, goodness gracious. Yeah.
All right, thank you. So another one here. So an emergency fund should be in a regular savings account, and it should be moved depending on trips, life events, and the amount of the emergency savings, either or in a high yield savings or in an investment.
Was it? I think I saw it said HSA, health savings account. Yeah, those are wonderful too. I mean, if you can budget that too. With the health savings account, as long as you actually use it for something that's, health related, or, there's a technical term that they use, like self-improvement there, prescription drugs, etc., doctors' co-pays, etc. That stuff is also a tax deduction as well. I have one here through University of California, Riverside, but that one there is separate and distinct from my emergency fund. And of course, with the HSA there, that actually does build a cash value as well, right there. So again, if you can have all of that, an emergency fund, an HSA, a 403B if you work in the public sector, and an IRA, a Roth IRA through your broker, I mean, you're doing very well, I think there. But yeah, HSA, look into it there.
Thank you. One more to touch on, since you mentioned public sector. I work in the public sector. Would you recommend a Roth IRA or a 403B/457?
Both, right? The 457, 403B plan there, that's through your employer right there. One of the key things there too is make sure you sign up for it. Right. A lot of times people, either both for 403B, 457, which is a little bit of differences, like in terms of like, I mean, they're pretty much the same things. There's a couple subtle differences there, but a lot of times people don't even opt into them right there. So just make sure that the default is automatic enrollment. And of course, that just like an IRA, that's not an investment. It's an account that you put investments into. Right there. So when you open up your 403B or 457 in the public sector, choose these ETFs, exchange traded funds or mutual funds there, and start doing it automatically through your paycheck, right? Whereas with the IRA there, that's through, that's on your own there. That's why it's called an individual retirement account. But if you can do both, do both, right there. I think it's important.
Thank you. Another one here is, what is the difference between qualified bonds and non-qualified, or qualified and non-qualified dividends?
Qualified dividends basically are when you actually have held the stock, and it's usually like a 60 to 90 days, in that they qualify as being in tax, not at your ordinary income tax bracket, but at that 0 to 15 to 20% tax rate, depending on how long you've actually owned the stock right there. So let's say if I bought a stock, goodness gracious, and sold it 2 weeks later, but I ended up receiving the dividend by somehow during that time period right there, that would be an unqualified dividend right there. I held the stock for short term, and I would be taxed most likely at my ordinary income tax bracket. But I've never ever done that, right? So it's anything that I've ever owned, for the most part, I've always owned it for like a very long time there.
All right, thank you. Another one here is, do you have to open a brokerage account in order to begin investing?
You do. It's just like any other platform. Like if you want to use Gmail, you need to create an account. So it's something just like that. If you want to, you can open it with anyone. Again, there are so many accounts which are, you don't have to pay a fee. There's no minimum account balance or anything. It's just like starting your, opening a email account kind of a thing. But obviously you do all your KYC and everything to, say that you're a real person. But yes, you need a brokerage account.
And it could just be Robinhood right there. If you don't want to even actually have it on your laptop, or I go to Schwab because I can actually once in a while go into the actual physical, tangible branch right there and talk to somebody. But, for the youngsters, Robinhood's probably fine. And even through your 403B or 401k, it's going to be done through a broker. Like we'd have Fidelity here at a UC system.
Thank you. One more here is, what is the difference between a financial advisor and a broker? Can a financial advisor be a broker?
I think I can answer that question. So a financial advisor would be one with more securities licenses. So basically he has given more exams and is registered with a company who has sponsored him to give these exams. A broker is more of a part-time job. So he isn't that well regulated. So whenever you're trying to get any kind of advice related to your investments, always talk to a financial advisor. Not saying that brokers are bad, but they are more well regulated by FINRA and SEC. So it's always good to talk to an advisor.
Thank you. The way I see it is, a financial advisor gives the advice, but a broker is more of the facilitator.
Yeah, he just connects people. He just connects the company and the people.
Exactly. Thank you. One more here. It looks like a little bit more of a technical one. What do you think of algorithm trading? From your experience, is it profitable?
It depends. So we also are working on machine learning in banking, especially for interest rate risk management and for regulatory reporting and a bunch of things. But there are challenges, and also with all the algorithmic trading, I'm sorry. The thing is, we don't have proof of how well these do. And also with machine learning, the back testing hasn't been as great as we want it to be. We also have benchmarks of what happens when we do quantitative analysis, when we do, statistical analysis, and what we get out of it. The results have been kind of better than what the results we've been getting through the machine learning models. And because of that, the industry has not really adopted a lot of the machine learning techniques yet, but there's a lot of research happening there. So I think we'll have to wait and find out how it goes.
Thank you. And here, as mentioned, do your research before investing. But how do I know which resources are reliable? What sources would you recommend?
I know I was the one who said this while presenting, and I would say this is extremely important because, again, getting your data, the source is always questionable. So what I do personally is I literally go to the SEC website and I download the annual report because, again, I'm in finance and I kind of understand a little bit of what's in an annual report. And even if you don't understand all of the numbers, I still suggest you go and read the annual report because it gives you a very good idea of what that company is capable of. And if you're someone like me who cares about where they invest, and if you want to hold it for the long haul, then do your research and literally just follow that company on LinkedIn, follow them on social media, just see what they're doing. Because a lot of times, especially with a bunch of new companies, things look good and immediately the stock kind of just tanks. So just because there's an IPO, you got excited, everybody's talking about it, you go and invest in it, and 3 years later it could completely go down. There are a few companies, I would not want to name them, but I did invest in one of them. It was a fitness kind of a company, and I just had to sell with 2% profit because I just didn't want to sell it in red. So I kind of wasted my time in the market by holding that stock. So get to know who the CEO is, who the founders are, and literally you can do your research without even looking at mainstream media because all the information is public, and that's the whole point of a publicly listed company. The point is that they give you the information so that you make an informed decision.
Thank you. And to kind of tie that back to what we were saying before, it could be a lot of work to individually watch stocks like this. More reason to potentially look at, index ETFs such as the S&P 500 and things like that.
I would also want to add that you can also use Yahoo Finance and Bloomberg. Again, I'm not sponsored and I'm not promoting anything here, but if you're still in the university, definitely take advantage of the Bloomberg terminal. It's very helpful. It gives you a head start. It helps you understand P ratios. It helps you do a quick comparison. And Yahoo Finance is also a free tool. So definitely use that. Even if you're using Robinhood or Fidelity, all of them have all that information you're looking for, all the basic indicators. So compare it within the industry. Don't compare like a tech company to oil company and then be like, oh, the P ratios are, different. So again, you need to know what you're looking at.
Yes, thank you. Always best to stay informed and educated. But with that, unfortunately, that is going to be our last question. We're getting close to time here. So on behalf of the UCR School of Business and Office of Alumni Engagement, I want to thank you all for joining us tonight for our investment webinar. We know it can seem intimidating to invest, and we hope to have helped simplify the process for you. The UCR Alumni Association strives to provide meaningful programming for alumni. They have many events and opportunities to engage in for over 150,000 Highlanders. They host in-person and online events, leadership opportunities through chapters and alumni association board of directors, and opportunities to volunteer in your community. We encourage you to go to the UCR alumni website and see the upcoming events. The website is alumni.ucr.edu. We also hope that you consider joining the UCR Alumni Association. Membership is completely free, and you receive discounts on travel and entertainment, as well as early access to special events like homecoming. I also encourage you to check out the UCR School of Business website for a list of upcoming events, such as the new School of Business ribbon cutting ceremony this week. As a reminder, this event has been recorded and will be on the UCR YouTube page. We'll also provide you all with a link to the video in a follow-up email. Thank you again to everyone for joining us tonight, and a special thank you to our speakers for their collaboration on this event. We wish you a great rest of your night.
Thank you.
Thank you, everyone.